This is Alan Bush with ADMIS. In the stock index futures yesterday, we did see the S&P, the Dow, and the NASDAQ all advancing to new contract highs. Also yesterday, we had an index of global equity markets advancing to new historical highs, surpassing the highs that were made last year. Also, we did have a variety of economic reports coming out this morning, which tended to be offsetting. We had the CPI coming in down 0.7%. The guess was down 0.6%. And this is the first year-on-year decline in the consumer price index since 2009. However, offsetting this to some degree, we did have durable goods coming in stronger. Jobless claims, though, showing a larger than expected increase. So some pressure developing this morning. However, I think this pressure will probably not follow through, and I would expect to see a recovery later today. And there's a very good chance we'll see futures trading higher on the day. Longer term, still looking for higher in all of the major stock index futures. Over in the currencies, the dollar advancing on very limited economic news. However, we remain in a 5-week trading range in the dollar index. Also, we are beginning to believe that the Eurozone economy is starting to stabilize. Recent economic numbers have come in a bit better than anticipated recently. So we are thinking that interest rate differentials, which had been at extreme levels favoring the dollar over most other currencies, are now beginning to become a bit more neutral. However, we are expecting the pound to continue to gain on the euro currency, with the pound even today advancing to a new 7-year high against the euro. So that trend will probably continue. Longer term, we would also expect the yen to gradually lose ground to the dollar. But I think I would tend to focus more on stock index futures and interest rate markets rather than on the currencies right now, which does take us to the interest rate markets. It does look like the 30-year bonds are making a bottom in here. Longer term, with inflation globally as low as it is, that will remain very supportive to the credit markets, especially at the longer end. So any further weakness off of the highs here, at least off of these recovery highs, possibly a point or a point and a half lower in the 30-year bonds, should be viewed as a buying opportunity. And I think the bull market remains intact for the Treasury, especially at the long end. And I think that this is a trend that will last for quite a few months. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.